Good morning, everybody. Welcome to our autumn 2024 budget webinar. For those of you that are joining us today, we're just going to look through the impact of this week or last week's budget, some key changes, the impact on both individuals, for employers and businesses generally. And at the end, any questions you may have, we'll try and answer. If you do have questions, if you'd like to pop them in the question section of the webinar, we will pick them up. And if there are items that are really technical that we feel a separate conversation will be, we can arrange that. For those of you not familiar with who we are, in terms of our group around the world, we've got 10 international offices, 51 in France, and some 1,450 professionals working across our range of services. We're giving this from our Allcom Civils office in London. We're chartered accountants, and we can help with accounting and corporate compliance, personal taxes, corporate advice, and audit work. A lot of what we're going to talk about today will actually be around the personal taxes side and around the business support. Your usual contacts are all available. So if there are specific or individual discussions that you would like to have, then please reach out to them and they will be able to give you the advice in the normal way. So thinking about the autumn budget, 170 pages of government text supporting that budget, and there were some 200 policy items included within those pages. We're not going to go through 200 items today. We've picked out the ones that we think will apply to the majority of our clients. But those 200 items in the policy section were in addition to all the comments on public spending and the economic forecasts, a lot of which was published in advance. A lot of it was subject to rumour in advance, and many of those rumours didn't happen. And the advice that we gave to our clients was, unless you were really going to do a particular transaction, don't do it as a result of the rumours. And I think in that point, we were proved quite right. So going into the text of the budget and thinking first about individuals, we were told in advance there would be changes to capital gains tax. It was one of the few taxes that hadn't been trialled in the manifesto for the Labour Party, and we therefore knew there had to be increases. Those increases were, as we expected, implemented from budget day and unusually applied to transactions on budget day and thereafter, and not from the day after budget day. New rates, the lower rate for those who don't use their basic rate band for income tax purposes, which is very few people, an increase from 10% to 18%, and the higher rate, which you may call the normal rate of CGT, increase from 20 to 24%. And those rates we already had and were already applied to residential property. So nowhere near as high as some commentators suggested in advance. Probably more appropriate to think about for those in business is the increase in the rate of tax for assets which qualified for business asset disposal relief, or the relief that you used to know as entrepreneurs relief, for those people who have more than a 5% shareholding in a small business. And those rates don't go up until next April, initially to 14% and then 18%. So a quite significant increase there for people who would be looking for business asset disposal relief. And that leads us to consider the timing of disposals, whether it can be achieved before the 5th of April 25 or before the 5th of April 26. Investors relief, which is a relief for those people who invest in unquoted companies but don't have control of, or don't have 5% of those companies, is being reduced from an allowance of £10 million to £1 million. So quite a significant reduction there. But again, it's a 14 or 18% rate, depending on when you dispose of the asset. An administrative matter that applies to those people with crypto assets is there will be new crypto asset reporting required from 5th of April 2025, and the detail of that is currently being included within the draft legislation, and we'll be looking at that as that information becomes available. So capital gains tax, the rate that changes we expected, but maybe not as high as we thought. Also for individuals, no change to the overall high income child benefit charge. That will still be removed from those people earning between £60,000 and £80,000. But from April 25, that will be collected through PAYE. So for those individuals who are subject to the high income child benefit charge, they're going to see quite a significant reduction in their monthly income from April, whilst at the same time potentially repaying any child benefit received in the current year. There was suggestion that this would become a family charge, but the complications of applying that to both parties in a couple, it was just a step too far for the revenue, and so it will still be collected from the highest earner, irrespective of who actually receives the benefit. We already knew, and the previous government in their spring budget had announced that furnished holiday lettings would cease to have the special treatment that they received and will now be treated just like any other investment in a property. So there will be restrictions to the amount of interest that can be claimed, restrictions to capital expenditure, and it will no longer be possible to use furnished holiday lettings to support pension contributions or to receive the lower rates of capital gains tax that apply to businesses. Another significant change is that the ownership is deemed to be 50-50 on a jointly owned property. And that may give us some opportunity to gift between spouses to maximise and optimise the tax position, so that the rate of tax, both on income and potentially on capital gains, is as low as possible amongst a husband and wife. Stamp duty land tax is a tax that never used to have a huge impact, but the rates now are significantly more, and the surcharge for additional dwellings increases from the 31st of October up to 5%. So a significant increase there, 2%, but it's on top of the standard stamp duty rates. Stamp duty will now also apply from properties over 125,000 and not 250,000. And the 0% band reduces to 300,000. For those with properties in a limited company, the 8-head rate increases from 15 to 17%, and that is a standard charge on all residential property within a limited company which has a value of over £500,000. Inheritance tax had been considered to be a tax that would be increased, and the increases that we saw significantly were around the inclusion in an estate of a pension fund that's been unused at the point of death from 6th of April 2027. This will change for many people their whole strategy around where they draw money from. Recently, because of the inheritance tax benefits, an individual with significant assets would take their income from those assets and not touch their pension scheme, so that they can begin to leave that to beneficiaries. It's likely now that we'll move away from that and suggest that people do draw against their pension and make lifetime gifts where possible to reduce their overall value of their estate. For a couple with an estate below £2 million, there is a potential total relief at the nil rate band of £1 million. That rate is being frozen until 2030. So a 2-year extension there on the freeze of the nil rate band. A significant change also to business property relief and agricultural property relief. These reliefs were really very useful for anyone with a business to pass it down the generations, including farms. And significantly also applied, business property relief also applied to shares quoted on the AIM market. And it could be a very good way to maintain access to capital, maintain income on that capital through AIM dividends, but get 100% inheritance tax relief. That will no longer be the case. 100% relief on agricultural property and business property will only apply to assets up to £1 million, with 50% relief on anything over £1 million. AIM shares will only receive 50% relief, irrespective of their value. So it's still a useful relief, because you would be paying half the rate of inheritance tax. But importantly, we will need to be considering whether the ownership of those assets is making best use of that £1 million between spouses and potentially between families. Disposal of business property has some special capital gains tax rules, so the gain can be deferred, and it may be appropriate to consider gifting down the family, consider ownership by spouses, because that £1 million is not a transferable relief. So each individual has £1 million relief. So a £2 million business would be better off owned 50-50 by spouses. Also making use of the 7-year exemption for inheritance tax gifts, if that can be passed down the family. So quite a lot of planning there to make sure that the reliefs that are available are fully utilised. We knew, because the previous budget had announced changes to what we call the non-dom rules for UK resident but not domiciled individuals. Those rules have been expanded. So the concept of domicile, which is a difficult concept because it's really looking at the long-term intentions of an individual, that concept has been abolished, and UK residents will now be taxed on their worldwide income and gains from 6th of April 2025. This follows the tax regime in many other countries where residents are taxed on their worldwide income. For those people arriving in the UK, for the first 4 years of their period of residence, they can still take advantage of the remittance basis and therefore not pay tax on their worldwide income if they have significant income overseas. But if they do that, they will lose their personal allowance and their capital gains tax allowance. So the issue there is to look at the size of that overseas income and decide whether losing allowances is a good or bad way of going. The remittance basis is based on, in general terms, on the number of days in the UK and the number of ties that an individual has to the UK. And ties for this purpose are things like the location of a family, the place of work, and the availability of accommodation. There will be opportunities for those who are already resident in the UK to take advantage of a temporary 3-year lower rate if there is a need to invest or to bring that money into the UK for investment purposes. Individuals who remit capital to the UK, but remit it specifically to invest in unquoted companies, can continue to avoid the non-dom charge for investments until 2028. Non-doms will also now be subject to UK inheritance tax on worldwide assets. Again, this was previously announced, but is being expanded and will apply from April 2025. UK assets have always been subject to inheritance tax, irrespective of the location of the individual in terms of residence. But from April 25, any individual who's been resident in the UK for 10 years will be taxed on their worldwide assets. The 10 years also has a tail, and that is for between 3 and 7 years after leaving the UK, individuals who have been resident here will continue to be taxed on their worldwide income. So particularly anyone thinking of leaving the UK in the period after April 25 will need to consider whether there's any planning opportunities to potentially leave earlier to avoid some of those tails. There are also some individuals, because of the ties to the UK, where a husband and wife may not have the same resident status, and there will continue to be special rules for the transfer of assets between those spouses, which is different to the UK rule, where transfers between spouses are inheritance tax free. Moving on now to some of the issues that affect businesses. And the first one was an increase that we probably expected to happen, and that was the increase in employer national insurance contributions, because again, there was no commitment in the manifesto not to increase employers' national insurance contributions. So from April 2025, the rate increases by 13.8%, by 1.2%, from 13.8 up to 15%. The area that wasn't expected was the reduction in the threshold from which employers' national insurance applied, and a reduction there from £9,100 down to £5,000. So this is an immediate £600 increase in the cost of employment for any employee who's earning between £5,000 and £9,100. To mitigate this slightly, the employment allowance, which is an allowance introduced to encourage employment, and which up until now took the first £5,000 of national insurance out of charge, is increased to £10,500. The employment allowance wasn't available to any employer that had more than £100,000 national insurance bill in a year. That threshold has been removed. So there is an opportunity there for all employers to claim the £10,500 employment allowance. Employment allowance is available whenever there's more than one employee in a business. And so consideration needs to be given to whether the employment allowance can be claimed by employing perhaps family members or increasing employment generally to make use of that. But clearly, if a family member is employed, you need to be really careful so that the work they do can be justified as being for the benefit of the business, so that you continue to receive corporation tax relief on those salaries. Payroll compliance will become more complicated for all businesses from April 2026, as any benefits in kind, with the exception of any loan interest, will have to be taxed on a monthly basis through the PAYE scheme. For employees, that means from April 2026, their monthly salary net of tax will go down. And again, this could be at the time that they're paying tax on the previous year's benefits. So some potential cash flow for individuals, as well as a lot more work for the payroll departments. So that will be something that needs to be pre-planned. Large organisations already have to tax benefits through payroll. It now applies to everybody. You'll be aware that the provision of company cars is subject to tax, and that benefit in kind is calculated on the basis of the original list price of the car, not the price the company may pay for it, and that can be up to 39% of that list price. To encourage and continue to encourage the use of electric cars, that benefit is significantly less, but will rise to 9% by 2029 from its current 3%. Low emission cars, so those with emissions of up to 50 grams of CO2, the rate there will apply to 19%. But you can see that, with rates of 9 and 19 compared to 39, there is a genuine encouragement there to reduce the use of high emission cars. Some other technical matters were that recruitment agencies will be responsible for ensuring that PAYE is paid by anybody employed through an umbrella company, typically involved in the consultancy business. And there were some technical changes to ensure employee ownership trusts and employee benefit trusts comply with the legislation and actually deliver the benefits that those trusts were intended to do for their employees. And finally, some general business tax updates. Many corporates have been really pleased to see that we now have a corporation tax roadmap, which is confirming the rates and allowances for the next 5 years. Those rates have been confirmed at 25% on all profits over £250,000, and that the lower rate of 19% applies to the first £50,000, with a marginal rate between £50,000 and £250,000. The roadmap has also confirmed that research and development reliefs will continue. So they give a lot of certainty there as to what the tax costs for the future will be. Small businesses who so far have not had to be involved in submission of tax returns through the Making Tax Digital process will be required to do so from April 26. For VAT registered businesses, they're already involved in Making Tax Digital, so not a huge change for them. But for smaller businesses and landlords, an additional administrative burden to be introduced. The implementation of VAT on private school fees had already been announced in the government's manifesto, and that's now confirmed to be set at the full normal rate of 20%, effective from the 1st of January 2025, with forestalling reliefs in there to ensure that anybody who made early payments will also have to pay the rates of VAT applicable at the time of the service, i.e. the term time, not when the payment was made, which is a slight difference to the normal VAT tax points. And finally, an increase in the rate of interest charged on unpaid tax from April 25, which will be at the base rate plus 4%, which is a big increase from the current position of base rate plus 2.5%, which is an attempt to try to recover the interest of the tax that's due, and to close down the lost tax within the tax system. We do see, a lot of businesses effectively using the revenue as a bank, and they want to stop that, hence the significant increase in the extra. So there's an overview of the budget as it affects individuals, businesses, employers. As I say, over 200 policy sections. We've covered just a few there, but the ones that are really important. So, as I said at the beginning, if anyone has any questions, please pop them in the chat and we will try to answer them. I've got one question. And that was a question that said, I thought we were already liable to tax on worldwide income. You are taxable on worldwide income if you are UK resident and UK domiciled, which was the change that was introduced, unless as a non-domiciled individual, and as I say, domicile is a concept of long term, in which case you could pay a fixed rate and not pay tax specifically on the income. So the difference is all worldwide income will now come into charge. And I've got one other question which I'm just looking at. Changes to the ISA and pension savings regime. There were no changes to that. ISAs remain a maximum of £20,000 per person per year, and lower rates for some other special types of ISA. And the pensions allowance remained, perhaps surprisingly, at £60,000 per year. So no changes there to those incentivized investments. Reading the next question. Capital gains tax at the new rates applies to all capital gains after budget day. So unusually a change of tax rate during the year, but a change of tax rate that you can understand because if not, we'd have been rushing to produce transactions before the end of the tax year to make use of the old rates. So the new rates apply. And yeah, just to confirm, no changes at all to personal pension processes. So thank you for joining the webinar today. As I say, your normal contacts within the Orcom Civils team can answer any specific questions that you have. Thank you for your contributions through the questions. I'm just going to pick up the last question, which you've just popped in. Question on furnished holiday lettings and what costs can be deducted. The running costs of the property can be deducted in the same way as you've been able to up until now, and that you're allowed to claim against all other rental income. So perhaps that's agents' fees. For furnished holiday lettings, it may be extra cleaning, maybe provision of arrival packs. What you won't be able to claim is the first capital item, so white goods, but you will be able to claim replacement of those items. And for many people who have furnished holiday losses, those will still be available to carry forward until they've been extinguished. So, as I say, thank you for joining. I think the questions have stopped. Please make contact with us if there's any specific questions. And if not, we will be seeing you at the next budget, which will probably be this time next year, as there's no indication at the moment that there is a spring budget planned.